Morning pair traders. Today we're going to look at the PTF Pro trade of the month for September 2018. We're going to be profiling a pair which is Apogee Enterprises versus Masonite International, and we've done this pair before. It's been treating us very well and it's been highly profitable, and we looked at that back in February. Let me just quickly show you that. If you go to the blog at pairtradefinder.com, there's a written analysis of this trade with a bit deeper fundamental analysis of the two symbols. So while I do the review today, we're going to skip more quickly over the fundamentals because you can always go to the blog and review it there. So what did we have here? We had a trade which we had an entry signal generated on the 8th of August, and it was buy 152 shares of DOR at 65.50, sell short 201 of Apogee at 49.84. The entry happened at a 2.18 standard deviation. The exit happened exactly 42 calendar days later, and here you have all the details. The exit was at minus 1.33 standard deviations when we got a big swing that day. As a result of that big swing, we got great results on the trade. The long leg made money, $334. The short leg made money, $1,479. The total net profit, $1,764. In 42 calendar days on $10,000 a leg, that's 17.6%, and up to a 44% return on CFD margin in 42 days. So we love seeing a trade like this, and let's go into some detail on the trade. So first and foremost, what are the two companies? And again, I'm going to go very quickly through the fundamentals. Apogee makes windows for all types of building. It's based in the US, founded in 1949, and they do residential, they do office buildings, multifamily, all of that, commercial, institutional. Masonite makes doors. So one makes the windows, one makes the doors. They also serve the same sectors. It's also a U.S. company. It's founded in 1925. It's in Tampa. Importantly, if we look at the general statistics here, and again, I'm just going to touch on this very briefly. Market cap 1.13, market cap 1.7, so very close. They are market cap consistent. Beta 1.64, beta 1.38. They are beta consistent. So those are the two most important things I like to look at, provided that fundamentally the business models are very similar. So I won't go in further detail. You can read the February blog about the different financial statistics of each company. So let's go straight into how this pair has performed historically. And if we go into Pair Trade Finder Pro, if we look at the back test, this is updated back test for yesterday. We can see that over the last 3 years, this pair has delivered 9 trades, average correlation of 42.5, co-integration, very nice co-integration, 0.97, compound annual growth rate of the pair of 19%, profit factor of 5, maximum drawdown of 17, delivered 7,700 of gross profit, 900 of commissions, 6,800 net profit, about 760 a trade average, and it's been doing 78% winning trades. Just jump over here. Average days in trade is about 27 days, so it also works quickly. Here you have the equity curve. You can see it did well for a year, then it kind of struggled for a year, and then the last year and a half has been very good. We have a nice ratio here, trend and not trending at all, going back and forth over a more or less flat ratio line, especially in the last year and a half, and that's what we want to see for a great pair. I would also just highlight it's delivering a really good compound annual growth rate, and the co-integration makes it quite attractive to look at trading. So that's our initial statistical arbitrage screen. So if we quickly just jump to the relative performance graph, this is over the last year, what we can see is, I like to see and confirm that the co-integration is working properly. We can see a broad correlation in the two shares, but not high, which we see it's only about 48%, but we can see the co-integration. So when they separate, they come back together. When they separate, they come back together. Separate, come back together. Separate, come back together. And that's what we want to see. So that's very positive as well. Now, the trade signal, as we said, was generated on 8th August. And we therefore need to check news, as we always do on every trade signal. So I have pulled up the news feeds from the websites for both of these. Let's first go to Apogee, and we can see here, this is over their website, this is their press release feed. No news in that period, which would cause you to think that there's been a fundamental change in Apogee's business. So that one's clear. And Masonite, what we do see, and which did generate the signal, is on August 8th, they announced their second quarter financial results. And I won't go into huge detail. If you wanted, and you should, when you see this, the signal is generated and you see that there's been an earnings release, you should always click on the earnings release and read it through, understand what's going on with the business. I've done that. I'll just quickly highlight what came out here. What came out here is that they're doing very, very well. So their sales are increasing, their margins are increasing, some of the acquisitions they did previously are being integrated well. And so there's not a fundamental change in the business. What they're just saying is that the business is going very, very well, and the management is delivering very well on that business. Okay, so that's great. The stock is somewhat re-rated because I guess obviously a positive earnings surprise is one of the strongest deliverers of alpha in a market. And so we look at this and you say, well, we're looking at relative value. So Masonite's doing better, and their releases said they're doing better. Does that mean we shouldn't take the trade because, Apogee isn't? Well, Apogee reported in June 28th, so this information is like a month and a half later, almost a month and a half later, and they're not going to report again until, the end of September. They did it again in September 18th. So my take on that is, because there's no M&A, there's no corporate action, there's no major announcement of any problem in the business, rather that just things are going very, very well. This is the nature of pair trading. We have selected these two stocks because they're in the same industry sector, and if Masonite's doing very well, Apogee should also be doing very well, and that's the whole reason we're taking the trade. And they've diverged, and we're expecting them to reconverge. So that would not cause me to throw out this signal. In fact, it would cause me to say this is exactly what we're looking for, and my expectation would be that Apogee will catch up to Masonite and give us a good trade. So the only thing left to check on news and calendar is when do they pay dividends and when do they have their next results. So the signal was on August 8th. Results are not going to be announced on Apogee until September 18th, which gives 40 days more or less. That's more than enough for 27 average days in trade. Their last dividend was also, when did they pay it? So they declared in June 28th, so their next declaration of dividend that might shift the market won't be until, again, end of September, so that's clear. Masonite doesn't pay a dividend, so that's clear, and we know that the earnings results were announced on August 8th for Masonite, so the next results won't be announced for another 3 months approximately. So we're all clear on dividends and we're all clear on announcements, so that makes this clear to trade from that point of view. So the next thing I would do is go to the pair charts and just quickly review them. So here's the signal, okay? And we're seeing it's just above 2, which is fine. That's what our parameters are. And over here we see the ratio and its moving average. And what we see is it's up here, so it's a bit higher than these highs, but it's certainly within historical averages. There's a bit of a resistance line here. It's touching up against that resistance, but certainly it's nowhere near out of range. So we wouldn't be concerned about that. What we like best is that we're seeing a very flat ratio line. And then we would look to see is the RSI at an extreme to give us a technical overlay to say that this ratio may be getting close to a point where it might turn around on this big bull tear it's had here. So yes, on that day we're at well over 80 on the RSI. So that's a very extreme reading. And that would lead us to believe that there's a chance it may be turning around sometime soon. We don't really see divergence. If I'm seeing these two highs and I look at these, it's still sloping upwards. You could call it flat and these upwards, so there might be a minor divergence, but I wouldn't put much stock in that divergence. I'd love to see the divergence. It's not really there, but you have an extreme overbought reading on this ratio, and that leads me to say that looks like a pretty good time to get in. So non-trending ratio, no ratio breakout. RSI looks good on an extreme. We should look at the correlation. And let's just quickly oh, by the way, before we do, we've got the volatility graph here. So what we can see, it's been volatile in the past, and it's been lowering its volatility. It's down for the last year and a half, it's between 2.5 and 3 Right now it's closer to 2.5. 2.7. That's slightly more volatile than a typical pair of say 1 to 2%. So when I'm in the 2 to 3% range on volatility, I might scale back the position size. I might not do this at 10,000 a leg. I might do it at 7,500 a leg, something like that. So that's the volatility side of things. And if we just quickly look at correlation, let's just bring up the correlation chart. Correlation chart, this is the last 9 months or so. So it's been 60, coming up to 70, and bouncing around between 40 and 70, which it doesn't have these huge historical swings. It's been more or less constant. We've seen these pairs are correlated but not highly, so it's more the co-integration that we're after, and we've seen that the co-integration looks good over the last year. So this would not cause me to throw out the trade. In anything, I just consider it a bit of a neutral. So that's why we would have taken the trade, and had you done so, these were your results. So on 18 September, the signal came in. Again, let's take a look at that. Here's the exit signal. So we had I think it was the results catching up, as we suspected they would do, of Apogee to Masonite, and the exit was triggered here at minus 1.33, and so that's why we got a bit of extra oomph in the trade, and made more money than the average profit per trade usually on this pair. So if you were in it, congratulations. It was a nice trade, and it made lots of money for us. The total gross profit again was about 1,800, and net profit 1,764 in 42 calendar days, 17.6 on nominal leg value, 44% return on CFD margin. It would be great if they were all like this, but this is the trade of the month for September 2008. Happy trading, everyone.